N. Good evening, everyone, and welcome to today's market analysis. Global risk assets, after a period of consolidation with subdued trading volumes, saw an oscillating rebound today. However, this was marked by significant internal structural divergence, far from a broad-based rally. The interplay of geopolitical risks and internal sector rotation, alongside the release of market panic, is now the central theme of our focus. Let's quickly review some key market data. Overnight, U.S. equities saw the Nasdaq and S&P 500 close slightly up by about 0.2%, with the Dow Jones reclaiming the 50,000-point mark. The VIX Volatility Index notably fell by nearly 4% to 16.76, indicating an easing of market fear. However, the 10-year U.S. Treasury yield ticked up by 0.31% to 4.59%, and the U.S. Dollar Index, DXY, remained stable at 99.19. In commodities, WTI crude oil was down almost 1.5% at $97.75 per barrel, while spot gold gained 0.38% to $4,542.60 per ounce. Today's strongest sectors globally were U.S. storage chips and quantum computing, while in A-shares, humanoid robots and intelligent driving stood out. Conversely, the weakest performers included U.S.-listed Chinese concept stocks, and A-share semiconductors and AI computing power. Looking at the global market trajectory, A-shares undoubtedly became the eye of the storm today. The market opened higher on optimism, with the Chi-Next index at one point rising over 2%. However, the mood shifted dramatically in the afternoon, as high-flying tech stocks collectively plunged, dragging the index down with heavy volume and causing the Shanghai Composite to lose the 4,100-point level. Market sentiment rapidly swung from morning exuberance to afternoon panic selling, completely failing to sustain the previous day's U.S. market gains and charting an extreme, independent course. European markets, meanwhile, were direct casualties of escalating geopolitical risks and the EU's downgraded economic growth forecast, experiencing a broad sell-off that intensified global market tensions. In contrast, the U.S. market displayed remarkable internal resilience. After opening lower, weighed down by negative sentiment from Europe and Asia, capital quickly rotated out of leading AI stocks like Nvidia and flowed into new tech subsectors such as storage chips, represented by ARM, which surged over 10%, and quantum computing. This rotation ultimately propelled the Nasdaq and S&P to a marginal close in positive territory. The significant drop in the VIX index further corroborated that market panic was contained and repaired during U.S. trading hours. Today's turning point occurred during the A-share afternoon session, with its panic selling acting as the initial trigger for global market sentiment. The U.S. market, however, emerged as the sentiment leader, refusing to follow the pessimistic mood of other global markets and successfully achieving internal repair. A-shares, on the other hand, proved to be a clear drag, exposing the fragility of their internal trading structure. Digging deeper, the U.S. market largely ignored the escalation of Middle East geopolitical risks, which had already been priced into European markets, and a somewhat hawkish Fed meeting minutes. This suggests that capital remains inclined to seek opportunities within the market rather than retreating to the sidelines. A-shares, conversely, overreacted to rumors concerning quantitative trading regulations, amplifying panic, which is a clear sign of weakness. We previously overestimated the spillover effect of positive U.S. market sentiment and underestimated the immense pressure for profit-taking in high-valuation A-share tech stocks. A clear structural signal has emerged. The AI investment thesis is undergoing a profound internal structural divergence. Capital is shifting from shovel sellers, such as GPU manufacturers, to more downstream or related areas, like storage, applications, and robotics. This isn't the end of the AI rally but rather its evolution into a more refined second stage. Simultaneously, A-share capital flowed into the financial sector for support during the panic, a strong defensive signal. Looking ahead, we anticipate A-shares to attempt a technical recovery tomorrow, likely opening flat or slightly lower. After the massive release of panic selling, short-term selling momentum should be exhausted, creating demand for a bounce. However, The hesitant U.S. market performance and external macro pressures will likely limit the rebound scope, leading to an overall bottoming out pattern. The CSI 300 index is expected to trade with a positive bias within a range of plus or minus 0.5%. The internal divergence within U.S. tech stocks is likely to continue, with Micron Technology, for instance, potentially outperforming Nvidia. The 10-year U.S. Treasury yield is projected to remain elevated, oscillating between 4.55% and 4.62%. The VIX Volatility Index should stay low, closing below 17.5. WTI crude oil prices, supported by geopolitical premiums, are expected to trade with a positive bias within the range of $97 to $100 per barrel. Our strategic recommendation for tonight and tomorrow morning is to remain on the sidelines. However, if A shares open lower tomorrow and quickly turn positive within the first half hour, and if the semiconductor sector, which led yesterday's decline, shows signs of stabilization, one could consider a light position in fundamentally sound, oversold industry leaders, aiming for an intraday recovery. Conversely, if A shares continue to fall with heavy volume after the open, breaking below today's lows, or if the US dollar index DXY breaches 99.5 during Asian trading hours, all bottom fishing ideas must be abandoned. Today's overall market probability leans towards 40% for consolidation, 35% for an uptrend, and 25% for a downtrend.